Hello, everybody. Thanks for tuning in. I want to talk about a style of investing. It's not typically what we do, but I think it's worth learning about. We're more trading, and this is more of a fundamental process or view, but we kind of do it all over here at Stock Market Jobber. So I just want to show you some research I did on a company a few years back. What the idea is here is to figure out what the earnings of a company are going to be. And if we think that the earnings are going to be better than what Wall Street predicts, we're going to buy the stock ahead of the earnings because hopefully, if they release really good earnings that are a surprise, the stock will go up and then we can sell it. Vice versa, as you can imagine, if we can figure out that the earnings are going to be worse than expected, and the stock is going to go down, well, then we could sell it or short it or buy the puts ahead of the call. And then when the stock settles out, then we cover. So I'm going to just look at this Badger meter. Now, one of the things we can do is go to the website, scroll all the way down to the bottom, and you're going to come across something that says either investors or investors relations. In this case, it's investors, but the vast majority of big companies on their website will have investors page. So we're going to go to that. And a couple things here. All right. First is let's take a look at their earnings presentation. Now, what I've learned over the years is that sometimes you can learn a lot about a company by not what is in the earnings presentation, but what is not in the earnings presentation. Now, my experience is that if a company is doing really well, they're going to have the numbers right up front. It's going to be in the first couple pages. Like, what is their income? What are their earnings? If a company is not doing so well, those numbers are going to be way in the back or maybe not even in them at all. Good example is a lot of these cannabis companies. You go into their presentations and all you see is these pictures of like this incredible looking marijuana or whatever. But then you finally get to the last page, or maybe it's not even in there. You realize the company is losing a lot of money. So first thing to look at is, are the numbers right up front? So let's take a look at this here. So this is from April. All right, so this is just standard forward-looking statements. And we got a general page here, talks about what they do. Now, the fundamental analyst for this type of investing is going to know this stuff inside and out. You can almost look at it like a forensic accounting. They really dig into the numbers. They listen to all the earnings calls. They talk to the management. They read research reports. Maybe they talk to the company's customers, the company's suppliers. For example, you talk to a supplier and you say, "Hey, are you guys going to send a lot of whatever, this metal or whatever to Badger Meter?" "Oh no, they've really cut back." Well, guess what? That's a sign that the company's not doing so well. Just going to give an example there. So let's see what we got here. Oh, all right, we got sales, right? We got a little bit more of what they do. And guess what? We got the numbers, okay? So kind of right in the front here, page 5, and don't forget, page was a disclaimer and a page is a cover page. This is what we really want to look for here. Now look at this, operating income. This is what we call the operating margin. Okay, it's the amount of income they make divided by the sales. This is the bottom line, how much money a company is making after every dollar of sales. After all the costs are counted up, so forth and so on. If it's 14.2%, this means they're making, if they have $1 of sales, they make 14.2 cents on every dollar sales. This is their operating margin. We can see here that between the first quarter of last year of 2022 and the first quarter of 2023, the operating margin has grown from 14.2% to 15.7%. Now that's a really good sign. This shows that the company is becoming more efficient. We like it when we see increasing operating margins. As a matter of fact, I know some analysts that'll be the very first thing they look at. Is the margins increasing or are they decreasing? Gross margin's a little bit different. This is just your sales and your revenue. I'm sorry. This is your revenue and then your sales numbers, but it doesn't factor in all the same stuff that the operating income does. So gross margin is sales and costs, and we can see this has a really big gain. It's gone from 50.7 to 62.8. So this is up 23%. So this is a really good sign here. But I think the operating income is probably a little bit more important. If a company is increasing its gross margins, but its operating margins are decreasing, it shows that it's getting bigger, but it's becoming less efficient. So to increase your operating income by 32% is pretty outstanding. And to increase your margins by this much is pretty outstanding as well. All right, then we just got a bunch of other stuff in here. All right, again, we come to the investor page. Now let's see what else we got here. All right, one of the things we want to look at is, if you're a fundamental analyst, is to look at the annual report. The annual report comes out once a year, not surprisingly. And let me see if I can find it here. And this pretty much has everything in it you could possibly want to know about the company. All right, so this is their last one, which was from last January. But again, this is just an educational session here. All right, let me see, download this press release. Actually, this is just the earnings release. This is not the press release. This is not the annual report. All right, let's see if we can find the annual report here. Badger Meter. Oh, here we go. Annual report. Quick links. Okay. Here's the annual report. Now, some people find this stuff boring, like myself. Some people find it really cool. There's really no right way to trade or to invest. You have to do what fits your personality. That's why I find it kind of ridiculous when people have these things like, oh, if you pay money, you can watch me trade, blah, blah, blah. I mean, it's like you don't take karate to hire a sensei to have him beat people up for you. You hire the sensei so he can teach you how to beat people up if need be. So this gives an overview here of pretty much anything that's going on in the company. One thing to point out is that companies are run by people that have very different personalities, if we're speaking about personalities. When a company gets on its earnings call, they talk about, oh, we're doing this, we're doing that. They try to put things in a good light. And we have some managements are very optimistic, and they tend to overestimate what their future earnings are going to be. We have some managements that are very conservative. They tend to underestimate what the numbers are going to be. So when you study these companies and you really follow them and you really get familiar with them, you'll start to learn about the managements. Some managements are just downright liars. I mean, I'm not saying anything that's the case with Badger Meter. This is an excellent company, but we've heard people that just come downright and lie. And then you look for things like this too, like another company I was listening to, their first quarter earnings report, and they're talking about, oh, we got this new product. It's going to be the greatest thing since sliced bread. It's going to really turn things around, so forth and so on. Then the next earnings call, they didn't even mention it. They didn't even bring it up. So that tells you that something ain't right over at that particular company. Now, you don't need to listen to the calls once a quarter. You can go to the website and get the webcast, and you could just, they're generally about an hour. You just listen to them all, over the past year, past 2 years, or what have you. So this is the annual report. This pretty much covers everything you could possibly want to know. What they do, descriptions, they talk about their competition, raw materials. People that do this type of investing, or this type of strategy, I should say, where they're trying to predict what the earnings are going to be, they know this stuff inside and out. They might only cover 10 or 20 or 30 companies. They don't follow every company in the world, but they get to learn everything. Are they making a new factory? Or how's this product going? How's that product going? Oh, gee, one of the inputs of your main product, the cost just went up 30%. How's that going to affect your earnings? So you go through this whole analysis of pretty much everything. And by that, you'd say, all right, well, Wall Street says these guys are going to earn 20 cents a share. I don't think that they factored in the fact that one of the inputs that goes into their main product is up 30%. I think they're going to miss their earnings because of that. I think Wall Street is missing that. So they're saying they're going to earn 20 cents a share. I think they're going to earn 15 cents a share because what I just said, their input costs have gone up, and the Wall Street community is not really seeing that. And on Wall Street, a lot of the analysts that you hear about, like if you're watching CNBC or what have you, they're very biased. There's an inherent bias. So it's almost like they're earning. It's almost like you got to take everything with a grain of salt. See, this talks about what's going on in their inventories, the receivables or payables, talks about the compensation of the management, how long they've been there. Pretty much everything you could possibly want to know is in this. Well, let me go back to this whole thing about Wall Street analysts being biased. The vast majority of firms that provide research make their money on investment banking, right? If investment banking is, a company needs to issue a bond offering, or a company wants to take over another company, they have to hire an investment banker. These are the broker dealers, the investment banks. That's where they make most of their money. Another way they make money is put out research, but the investment banking is typically way more than the research. So say an analyst looks at a company and thinks, oh, this company sucks. These guys are going to lose money. I'm going to put a sell on their stock. I think it's overvalued by 80%, blah, blah, blah. And they put that out there. Now, let's just say you're the CEO of that particular company, and all of a sudden you think, oh, we got to do a bond offering. Let's go look for an investment banker. Who are we going to do this with? Oh, these guys got to sell on our stock. They say the stock is overvalued. Well, screw them. I'm not going to talk to them. We're going to go talk to someone else. This is why on Wall Street, I don't know the exact ratio, but it's like for every 20 buy recommendations, there's only like one sell recommendation. So you just have to be careful, take it with a grain of salt. Yeah, it's tainted just by its very nature. All right, so we got our balance sheet here, our income statements, so forth and so on. So again, this is the annual report. It comes out once a year, and it pretty much can tell you pretty much everything you want to know about what's going on in the company. Now, another thing we can look at is just going through the website, learning as much as we can. Oh, here we go, analyst coverage. I mean, this isn't going to give price. Yeah. So like these guys here, they're all going to have their buy or sell recommendations on these companies, but they want to maintain a good relationship. So they might be a little bit, let's just say, overly optimistic. We got all this other stuff here, all their news releases, their governance, management team. Good thing to do is look at the board of directors. If the board of directors are people that have a position on the board because they deserve it, as opposed to being the vice president's son who has no experience whatsoever. But in most companies, the board of directors are people that know a lot about this particular industry, right? This guy's from Raytheon. Very, very accomplished people here. All right, so we go into the company, we learn this, we learn that. And what we do is we have this model that I built here. This is the very first page, and you'll notice this is a little out of date, but it's still the same kind of purpose. If we go through all these numbers here, right, the margins, the percentages, the costs, you'll notice that this comes down here, and this gives what we predict or what the earnings per share are, okay? So these are actual earnings, and these here are just estimates. These earnings, when I had done this report, had not been posted yet. But here we have our earnings, and basically earnings is you take your net income and you divide it by the amount of shares, and that gives you your earnings. Now, I want you to look at something here. Well, let me go through this first here. So we got our balance sheet. One of the things to look at on a balance sheet is inventory. If inventory is really increasing, that's not a good sign typically, because what it shows is that a company's sales aren't that good. If they're not selling stuff, what happens? It goes into inventory. All right. So inventory increasing, that means if the company eventually wants to sell those products, they have to decrease the prices, and that's not good. Now, this is all stuff I derived by going through all the earnings reports and the annual report. We've got the geography here, what's going on in the different countries, and we're looking for trends. Okay, we're looking for trends. Oh, sales in Asia are like they're choppy, but all right, sales in Canada are decreasing. Now, why is that? I mean, I don't know off the top of my head, but we can look into it. This is part of this really deep analysis. These people that do this strategy know the old expression is they know what color the CEO's socks are, or is it what's in his sock drawer? I forget. But anyway, we're looking for trends. We just study these companies. Then we have some just accounting stuff here. We have their debt, all stuff that needs to be considered, their cash flow. But I want to bring you to this page, segments and estimates. Now, this is where we do our primary analysis, or the most important. So these estimates flow through to this income statement. So I am getting my estimates by looking at this. What is going on in their various segments? And this is all stuff that's in the annual report. They have, they have these different, So we have sales, we have percentages. So these guys only have two segments. They got water utility instrumentation and flow and industrial instrumentation. Now, going through these, I try to predict what we're going to see. So sales, I think that the sales are going to be higher. All right. So for let me see here. Sorry. So for the first quarter, they had 80.5, and that's 2018. Well, I'm predicting that they're going to have 82.5. So that's up 2. Slight increases here. Now, why? I put some of these things over here. Well, these guys provide meters, which is right in line with this whole green type stuff, because if you can have meters, you can prevent waste, so forth and so on. So notice how the sales are increasing, and I think that they were going to keep increasing. So the first quarter, they had sales of 105. This is in 2018. Here they have sales of 108. This is my prediction. Everything under here is my estimates. This kind of flows through, shows us what our operating margins are, what our gross margins are, what our costs as percentage of sales. Now down here, I put in things like, cost of sales. I think the ratio is improving. So the cost of sales is going to be lower. They have a big, they use copper prices. They use copper. Copper prices have moderated. So that's part of their cost of sales. These are just notes. And these are my estimates. So by really, really taking a deep dive and really studying these companies and listening to the management, going through their financials, just getting to know as much as you can, you put in your estimates, okay, on this page here. And this, I guess, is kind of interesting. But like I said, let's just think about this. All right, what could potentially affect their sales or their earnings that other people aren't picking up on? Did a competitor just launch a new product? That could take sales away. Is some of the input costs going higher? That's going to take away from the earnings. Are they building a new factory? How is that going? Is it running above cost? Is it running below cost? It's almost kind of like an infinite. Well, I don't know about infinite. I mean, but it's can just get really kind of far out there. So it's quantitative in the numbers, but it's also qualitative because you really have to know what's going on with the company. Are they gonna? Did a senior executive just get fired? Right? Are they subject to lawsuits? Are the taxes in a particular state where they operate going to go up? It just goes on and on and on. And once you really get to know this, you can come up with some logical reasons for what your numbers are going to be. This flows through back to the income statement. This is my predictions of what they were going to earn for these quarters. And I believe this was pretty accurate, actually. And that's it. If this pops up here, my estimate is that in the first quarter, they're going to earn 40 cents. But Wall Street says they're going to earn 35 cents. Well, hey, man, we're more than 10% ahead of their earnings here. I think it's probably a good idea to buy this thing ahead of the earnings. And then if it rallies on the earnings, to sell. Just say Wall Street says they're going to earn 50 cents a share. And I say, wait a second, with my careful analysis, I'm only predicting 40 cents. So there's a good chance when these guys report, this price goes lower. So I'm going to buy puts ahead of the call. I don't recommend to people to short stocks, but if you short stocks, then that might be the time. But I recommend to people that if you believe a stock is going to go down, just to buy the puts, because the most you can lose is the amount you spend. Whereas if you short something and then say the stock, say you're wrong and the stock blasts off, you could end up losing a lot of money. All right. So anyway, that's pretty much sums it up. You do a really deep analysis of all the segments and estimates. You go through everything you possibly can to try to get some insight into what they're going to report. Remember, you look at the stuff on their website. I think it's really interesting to look at their presentations. And again, if they're look for what they're not showing as opposed to what they are showing. Now, this here looks like, remember, this looks good. They have their numbers pretty much right at the front. Some of these companies that are doing poorly, It's you see this a lot in some of the cannabis companies, and maybe I'll cover them soon. But all they show is these pictures of weed and the people that work there. They don't even mention the numbers, right? And that's because they're losing hundreds of millions of dollars. It's kind of hard to make that look good. All right, everyone. Thank you so much. And I will talk to you soon.